Investing in the stock market isn't always easy. I mean, the stock market is the most accessible place for somebody to go and invest their money to build wealth, but at the same time, so many people lose their money in the stock market because they either don't know how to invest their money in stocks, they don't know how to research stocks, or they get emotional, they buy a stock, they see it go down a little bit, and then they sell at a loss, and then a few weeks later, the stock pops back up. I knew I shouldn't have sold! If you don't want to spend all of your time researching stocks and picking stocks and keeping up with stocks, then another thing that you can do, instead of just trying to invest in individual stocks, is invest in something called an ETF or an exchange traded fund. An ETF, you can kind of think of it like a basket of stocks, a group of stocks. Now what you're doing is, instead of trying to find the perfect company to invest in, you're investing in a group of stocks, which gives you exposure to a whole bunch of stocks. Now, if one of the companies in your ETF goes bankrupt, well, you're okay, because your ETF will have hundreds of other companies to make up for that loss. So even if one company goes bankrupt, it's not a big deal. But if you invest in one company and this one company that you invest in goes bankrupt, now your entire investment is gone. The nice thing about ETFs is it makes investing a lot more passive for you, because now you don't have to keep up with every individual company. You just find the right ETF, you throw your money in there, and you keep investing your money every week or every month, and now you're just consistently building up this portfolio of this ETF or ETFs that you like, and this ETF is doing all the work to invest your money for you. Plus, ETFs work just like stocks. You can start investing in ETFs with as little as $100, and you can buy or sell your ETF whenever you want. But the whole idea about investing your money in ETFs, just so you know, is you want to be investing for the long term. So we're talking years now, where you want to buy something and you want to just keep investing in it and hold it for the long term. That way you allow the market to grow and your companies to grow to make you more money. Now, the thing that makes ETFs really interesting is you have different types of ETFs that give you exposure to different types of stocks. And in this video, I'm going to be going over 7 different types of ETFs with different ETFs within each type, that we can understand some of the best ways that you can go out and start investing your money and building wealth. The first and probably the most popular group of ETFs are the ones that give you exposure to the S&P 500. So the S&P 500 is just the largest 500 companies in the United States that trade on the stock market. So if you are a company and you are one of the biggest 500 companies on the stock market, well, then you are gonna fall into the S&P 500. So this is literally just an index or a group of the biggest 500 companies on the stock market. A couple ETFs that will give you exposure to the S&P 500 are VOO and SPY. Small disclaimer, I do own shares of VOO. Now, what you need to understand about this is when you go out and you buy shares of VOO or SPY on the stock market, this is now an ETF. So when you buy either one of these, you're getting exposure to the 500 largest companies on the stock market. Now, you don't have to go out and individually buy each company. These ETFs are out buying these 500 largest companies, and they're managing that investment for you. So all you have to do is invest your money into here or here, and now you have exposure to the 500 largest companies on the stock market. Now, before I go any further, I gotta make sure this is clear. Investing money has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. Everything that I'm talking about today are just examples. I'm not telling you what to invest in, and I'm not telling you where you need to invest. I'm giving you examples of how these ETFs work and a couple ETF examples, that way you understand where to look. But I want you to do your own research, because there are a ton of ETFs out there, so you gotta find what's right for you. So the thing that differentiates these two ETFs is, one, who manages the ETFs, and then what this ETF actually invests in and how much. So this is a Vanguard ETF, and this is a Spider ETF. What that means is Vanguard, the company, is the one that owns and manages this ETF, and Spider is the one that manages this. By the way, just so you know, Spider is spelled SPDR. Now, when we talk about what companies an ETF is invested in, you want to look a little bit deeper than just the companies, because what's going to happen is both of these ETFs are both going to be invested in the biggest 500 companies in the stock market, but one might be invested more in Microsoft than Apple, the other might be more invested in Tesla, and so they both give you exposure to the top 500 companies, and this is where you can do a little bit of research and see how much each ETF is invested into what. One of the easiest ways to do that is just to go to finance.yahoo.com, and then you can just enter in these two ticker symbols, and then you'll see, if you scroll down, you'll see some of the top companies that each of these ETFs are invested in. Or you can go onto the Vanguard website or the Spider website, and they'll show you which companies these ETFs are invested in and how much. That way you can get an idea of which companies you're getting exposure to. Another thing that you can pay attention to when we're comparing different ETFs is the expense ratio. The expense ratio, if you go to finance.yahoo.com, you'll see it there. You'll also see it on both of these websites. This is how much money you're paying to have your money managed by this ETF. So the advantage with an ETF, especially a low-cost ETF, is you're gonna pay way less money to have your money managed here than to have somebody physically managing your money with an actively managed portfolio. So these type of ETFs, these are passively managed, meaning they're managed by a computer. So all these ETFs are doing is they're giving exposure to the top 500 companies in the stock market. If one of the companies in these top 500 companies goes bankrupt and gets smaller, well then this ETF or this computer is just gonna kick out that company and it's gonna put in the next biggest company. That way your money is still being managed by the computer, but it's like an algorithm. It's gonna give you exposure to the 500 biggest companies. The expense ratio on both of these ETFs are very low. It's less than 0.1%, which means if you invest $10,000 into one of these ETFs, they're gonna charge you less than $10 a year to manage your money. But that expense ratio is definitely something you want to remember as you start comparing more and more ETFs and as we go deeper in this video, because you're going to learn about different types of ETFs. And so if you're trying to compare different types of ETFs and see what's better for you, the expense ratio is something you should be paying attention to. The second type of ETF that you might want to consider is a total stock market ETF, kind of like VTI. So a total stock market ETF gives you exposure to the entire stock market. Previously, we talked about the S&P 500 index, which gives you exposure to the 500 biggest companies in the stock market. Something like VTI will give you exposure to the entire stock market with big companies, medium-sized companies, and small-sized companies. So now you're literally just investing your money in the stock market, and if the stock market goes up, your ETF should go up. If the stock market goes down, your ETF in general should go down. So now you're essentially giving yourself exposure to the entire broad market. This is another Vanguard ETF. And the thing you got to understand about this is if you don't know what sector to invest in or what industry to invest in or kind of a more generalized place to invest, then this might be a good place for you to invest, because now you're just investing your money in the stock market and you're hoping that the stock market will go up. So if you believe in the United States economy, then you should be believing in the United States stock market, which means that in the long term, the United States stock market should go up. And if it does go up, well then this ETF will give you exposure to that. The third type of ETF that you want to consider are high dividend yielding ETFs. So there's two ways that you can make money in the stock market. You can make money through appreciation, which is when you invest your money in a stock, you bought it for $100 a share, and then the price of the stock goes up to $200 a share, and then you sell. You just made $100 because the price of your stock went up. This is called appreciation. But the second way that you can make money in the stock market is through something called dividends. So at the end of the year, some companies have a lot of cash in their bank account. And when a company has a lot of cash in the bank, there's a few things that they can do with this money. They can save this money for emergencies, they can invest this money back into the company, or they can pay this money back to the investors. They can literally just give it back to you in a cash payment called a dividend. A good company should do all three. So a good mature company is going to save some money for emergencies. They're going to keep investing in their growth. They're going to hire more employees. They're going to open more offices. They're going to open more stores. And then they want to reward their investors, their shareholders, people like you, for investing in and believing in the company. So this is where you have to understand what stage a company is in to be able to pay out a dividend. Because if we're talking about a small startup growth company, well, this company's goal is probably not going to be to reward their investors, because their goal right now is to get as big as possible, as fast as possible. So what they're going to be doing is not saving their money. What they're going to be doing is not paying this money out to their investors. What they're going to be doing is taking all of their cash and more through debt and other investments, and they're going to be reinvesting it back into their company. They're going to want to get more users. They're going to want to get more customers. They're going to want to open more stores. So smaller startup companies are not going to be paying out dividends because they want to get as big as possible, as fast as possible, and every dollar that they have is going to be going right back into their company. But some companies, your more mature companies or larger companies, are going to have this extra cash pile because they're already very large. And at the end of the year, they're going to have a huge profit. And if they want to pay this money out to their investors, one way they can do that is through dividends. It's an actual cash payment that you get without even selling your stock. Now again, there's a couple ways that you can get exposure to these dividends. You can go out and you can individually invest in companies that are paying out high dividends, or you can invest in a dividend paying ETF. So if you invest in a company that's paying out a high dividend, well, now the pro is you'll be able to get a high dividend, and if you invest in a good company, the value of your company will go up. But now the risk is if this company starts to tank, if they are on the verge of bankruptcy, if they start losing money, well then they're going to be forced to cut their dividend, and you can see their stock price crash. The advantage of an ETF now is now you don't have to worry about trying to find the perfect company again, because this ETF is going to give you exposure to a whole bunch of different high dividend paying companies. And now if one company tanks or goes bankrupt, you'll be okay because you're getting exposure to a wide range of companies. The con here is you're not going to get the highest possible dividend because some companies are going to pay a higher dividend than others, and your returns are also going to be averaged out because some companies are not going to do well, but other companies are going to do great. So the goal with an ETF is not to get the best return possible, it's to get a slow and steady, consistent return through the market. A couple examples of ETFs that are focused on paying you dividends are VYM and RDIV. Again, these two ETFs are in the business of trying to get you high dividends. This is where, again, you have to know what your goal is as an investor. I know I've talked about this at least 100 times on our YouTube channel, which is why if you haven't subscribed to our channel, make sure you do that. But this is where you got to know your goal, because if your goal is to see your investment portfolio grow as big as possible, then you don't want to be investing in these high dividend ETFs, because these companies are now taking their money and paying it out to their investors instead of taking their money and reinvesting it back into their company. So what you want to do, if your goal is to see your portfolio grow as big as possible, as fast as possible, is not invest into these dividend paying companies. These ETFs are focused on producing you consistent cash flow. It's not going to be the highest cash flow possible, but their goal is to give you consistent cash flow that you can count on. Like what we saw happen in the 2020 pandemic was a lot of companies started to struggle. And because of that, lots of companies started pulling back their dividends. And so people who were invested into these companies that were paying out dividends, hoping for consistent cash flow, were then all of a sudden, almost overnight, left with no more cash flow coming in because lots of companies cut their dividends. And so the whole idea here is to get a safer, which also means lower return, but a safer, more consistent dividend income. The next type of ETF that you may want to consider investing in are emerging market ETFs. The whole idea behind this is, well, now you want to diversify your money outside of just the United States, because the reality is every economy has its own struggles and no economy can continue booming at a consistent rate forever. The United States is the leading economy in the world. The United States is the strongest economy in the world, but some people are naturally worried that another company is going to come around and their economy is going to grow bigger than the United States. Or they're also thinking that smaller countries around the world are growing faster than the United States right now, which makes sense because smaller companies grow faster than bigger companies. When you're this large, big behemoth of a company, it's much harder for you to invest in innovation and grow much bigger because you're already very large. But if you're a small company, well, now you have the ability to grow way bigger faster because you're small, and so you have a lot of opportunity to grow. It's the same with this here. When you're investing in emerging markets, the whole idea is you're taking on a little bit more risk because you're investing in new countries, things like China and India and Brazil. And what you're hoping for here is that these smaller countries are going to see economies that are going to grow faster because they're smaller and they have the opportunity to grow bigger. Plus, you naturally have some people that are a little bit worried about the long-term health of the United States economy, so they want to diversify some of their money outside of just the United States economy. And one way that you can do that is by investing your money into emerging market ETFs, because this gives you exposure to the economies of different countries around the world. Again, a couple examples of this would be VMO and IEMG. These are two different ETFs that give you exposure to emerging markets. Now again, this is where you want to do a little bit of your own research and see which countries each ETF is investing in and see what you'd rather have. Do you want more of an exposure to China, or do you want more exposure to South Korea? And so you just got to figure out what's important to you, because this ETF is going to give you more exposure to China. This ETF is going to give you exposure to a broader range of countries. But now we're just getting into the details, because in either case, you're going to be getting exposure to emerging markets and emerging countries around the world to give you some diversity outside of just the United States itself. The fifth type of ETFs that you may want to consider investing in are innovation ETFs. We are in the innovation age right now, where technology is growing and innovating way faster than we've ever seen happen before. I mean, for all the 80s and 90s babies out there, you probably remember that when you were a kid, the internet wasn't what it was today. When you had to go on the internet back when you were a kid, you had to make sure that your mom or your dad wasn't on the phone because you had to go through dial-up, and anytime you went on the internet, it was a... You remember that whole sound bite that you had to go through to get on the internet? Well, now look at how far we've come with innovation. And so if you want to invest your money into the future of innovation, then you can look at innovation ETFs. So some of the most popular innovation ETFs are managed through the ARK fund, which is managed by somebody named Cathie Wood. And Cathie Wood is now a famous investor because of the returns that she's gotten her investors. And just a disclaimer, I do have my own money invested in a handful of different ARK funds. But the whole idea behind these ARK funds, their symbols are all ARK, A-R-K, and then something. Like ARK-K is their flagship innovation fund. If you put in a G here, it's the Genome Fund. If you put in an F here, it's the FinTech Fund. They have a fund for space exploration. They have a fund for a lot of different things in the innovation space. You can just go onto the website and see the different funds that they are. But again, the whole idea here is you are trying to get some exposure into the innovation side of the world. Another thing that you want to understand about these is that these funds also come with their own fair share of risk, because you're investing in a lot of smaller companies and a lot of startup companies. And these funds are also more on the actively managed side, which means that you have people actively working to try to find the best companies to invest in. And so your expense ratio, remember we talked about that a little bit earlier in this video, is going to be a little bit higher here because now you're actively paying somebody to help manage this fund. But if you're one of those people that wants to be invested into the innovation side of things, into the newer companies, into the newer technology, and you want to hope that one of these smaller companies takes off, well, then some of these ETFs might be right for you. The sixth place where you may want to consider investing your money in ETFs are REIT ETFs. I didn't write the word ETF. REIT ETFs. And what a REIT is a real estate investment trust. So for all of my real estate people that want to get exposure to real estate on the stock market, this can be a way for you to get exposure to that by investing your money in REITs. When you invest your money into a REIT, you're investing your money into a company that invests in real estate or that invests into mortgages. So you're not getting direct exposure to the real estate per se, but you're investing in the company that invests in real estate. So the whole idea is if real estate goes up or if real estate is really booming, well, now this company is going to be booming because it's investing in real estate and you're investing in that company. So it's not a direct investment in real estate, it's an investment in the company that invests in real estate. A couple examples of REIT ETFs would be VNQ and IYR. Now, the thing that makes REITs interesting is REITs are required by law to follow something called the 90% rule, which says that REITs are required to pay out 90% of their taxable income or their profits to their shareholders, people like you, through dividends. And so a REIT's income comes through rental income, because these REITs own these rental properties, these investment properties, and they make money from rent. And then after they pay all their expenses, their management fees, their property insurance, their utility bills, their property taxes, their other fees, once they pay all their fees, then they take the rest of this income and 90% has to be paid out to people like you, shareholders, through dividends. An ETF's job, again, is to minimize the risk for you. So now instead of you trying to find the best REIT to invest in, now you can invest in a REIT ETF. That way we get exposure to a whole bunch of different REITs that we don't have to worry about trying to find the perfect REIT to invest in, because REITs do have a lot of volatility, especially the ones with the higher dividend yields. And this brings me to the seventh type of ETF that you might want to consider investing in, which are your growth stock ETFs. These are your companies that are trying to grow as big as possible, as fast as possible. And then within these growth stocks, you have your large growth stocks and your smaller growth stocks. Your larger growth stocks are a little bit more mature. These are your companies that might be making profits, that might be paying out small dividends, but they're still really investing in their growth. They're still investing a lot in innovation because they still want to grow bigger. So the first example of this would be investing in something like QQQ. So QQQ gives you exposure to the NASDAQ, which is essentially the 100 largest companies which are not financial. So these would be companies like Amazon and Apple and Microsoft and Tesla. A lot of these companies are tech companies, but when you're investing in QQQ, you're getting exposure to 100 of the largest non-financial companies, which many of them are in the tech space. On the other hand, you also have the small cap growth stocks where you can get exposure through something like SYLG. So SYLG invests into the smaller cap growth companies, and these are going to be a lot of companies that you might not have heard of. A couple popular ones are things like Crocs and maybe MicroStrategies, but the goal with both of these ETFs are to give you exposure to these growth type of companies. One gives you exposure to the larger cap ones. These are going to be more of the companies that you've already heard of. This one gives you exposure to the smaller cap companies, the smaller companies that are really fighting to become much bigger. Remember, more risk comes with more potential return, but you also have more chances to lose your money. This again goes back to your goal. What do you want? More risk comes with more potential return, but it also comes with more risk. Less risk compared to this comes with less potential return, but also less risk. Now, the key for any of these investing strategies to work that I discussed is you have to stay consistent and you want to keep investing your money, whether it's every week or every month. You want to keep investing your money into these ETFs. That way you can continue to build your portfolio of these ETFs. That way you can keep fueling the fire. And then you want to make sure that your fire has time to grow. The best way to build wealth in the stock market is to leave your money in the stock market for the long term, because the people that make the most money in the stock market are the people that invest for the long term. There's always somebody who's screaming that the stock market is going to crash, and you're always going to have somebody who's yelling that the stock market is about to rally. But what you need to understand is that bulls make money, bears make money, but pigs get slaughtered. In the Wall Street language, bulls are people who think the market is going to go up. Bears are people who think the market is going to go down, and pigs are people who get greedy. So who makes money? People who think the market's going to go up, people who think the market's going to go down, but the people who lose money are the people that get greedy. You can make money when the market's going up, you can make money when the market's going down, but if you're getting greedy, well, you're the one that's making both of these people, the bulls and the bears, rich. The stock market almost acts like a double-edged sword, because the reasons why the stock market is so great is the same reason why the stock market causes so many people to lose money. The reason why the stock market can be a great wealth-building tool for so many people is because it's liquid, it's easy to access, and it's easy to value. When you invest your money in the stock market, you can sell your stocks whenever you want when the market is open. It's easy to value because you can go onto any stock market brokerage, website, app, or research company, and you can see exactly how much Amazon or Tesla is trading for. And it's super easy to use because you can start investing in stocks with as little as $1. But those same reasons are the reasons why people lose so much money in the stock market. It's liquid, so it's easy to sell when you get scared. It's easy to value, so you can easily get greedy. You can easily start panicking when you see a market down. And so that's when you can sell quickly. And because it's so easy to access, anybody can start throwing their money into the market without any sort of financial education. And if you leverage up your bets because your brokerage tells you or some random person on the internet tells you that you should go into debt to trade stocks because now you can 10x your returns, well, now, yeah, you can make more money when things go up. But when things go down, you lose even more money. There's an infinite amount of strategies out there on how to make money in the stock market. Everybody has a different strategy. Everybody has a different formula. And there are so many different ways that have been proven to show how to make the most money in the stock market. But the reality is, for the vast majority of people, if you just want to build sustainable wealth in the stock market, you should not be following these complex, these crazy strategies that have these expensive fees. There are simple solutions that you can do that bypass all the complexity, that bypass all the time invested, and that bypass all the fees that allow you to build sustainable wealth over the long term. Take a look at this chart right here. This is a 100-year chart of the Dow Jones Industrial Average. This is a 100-year chart of essentially the stock market. And what you see is that you have booms, you have busts, you have recessions, you have crashes, you have ups, and you have downs. But over the long term, what do you see happen? The stock market has risen over the last 100 years. See, what most people are trying to do is they're trying to time the top, they're trying to time the bottom, they're trying to find the perfect company, they're trying to do all this research, which works for maybe 5% of investors. But for the other 95% of people, you don't need to be spending all that time, effort, money, research, trying to understand how to make the best returns. For 95% of people who don't want to be active investors, who don't want to be actively looking for the best companies, who don't want to be actively listening to earnings calls, who don't want to actively be reading cash flow statements, balance sheets, and income statements, if you don't care about doing that, if you just want to make money in the stock market and not have to think about it, then there's a simple strategy that you can follow. And this doesn't mean that you have to go and find the next hot stock. You don't need to go and find the next Tesla before it booms. You don't have to go and find the next Amazon. You don't have to go and try to pick the best company. You can just invest your money in the stock market and let the stock market do its thing. Because if we go back to the chart, just take a look at the chart. Over 100 years, what do you see? Well, the stock market has gone up. Yes, you have booms, you have busts, you have times where the market goes up and you have the market goes down. But if you just invest your money into the market and you let the market do its thing, it has been proven over the last 100 years that the market goes up over time. Why? Because if you believe in the American economy, if you think the American economy will continue to grow, that the American economy will be stronger 10 years from now, 20 years from now, 30 years from now than it is today, then the stock market should also follow that same pattern. Yeah, maybe you're going to see some different booms and busts, but over the long term, if you zoom out, what you'll see is as long as the economy keeps growing, the stock market will continue growing as well. I'm going to show you exactly how to follow through with the strategy in just a second, but the nice thing about this strategy is it doesn't matter if you're entering a recession, or if you're in a recession, or if you're in a boom. The strategy doesn't change because this is a long-term strategy. If anything, the only thing that you would do is if you go through a market crash or if you go through a recession, the only thing that you would do is buy more. You don't change your strategy. With a long-term investing strategy like this, you just let the money work on autopilot, and the only thing that you would do is if you see a market crash, you just buy more. This is a long-term strategy to build wealth over the long term, and by long term, I mean 20, 30, 40 years. I'm not talking about 2 years. I'm talking about a long-term strategy where you invest your money into the stock market to own a piece of the economy. That way, as the economy and the country grows over the course of your life, well, your wealth grows as well, and you don't have to spend hours of your time. You don't have to pay these excessive fees. You can just let your money run on autopilot and just watch your wealth grow year after year after year. Does that mean that it's going to go up every year? No. You're going to see crashes, you're going to see busts, you're going to see recessions. That's a part of the economy. But when everybody's freaking out, when everyone's talking about the world ending, when everybody says we're going to enter World War III, when everybody says the stock market's going to crash, we just let your strategy do its thing. Because this isn't new. This happens every 10 to 15 years. You see booms, you see busts. We've seen a recession pretty much every 10 to 12 years for a century now. So you can expect that to continue to happen. And every time that happens, everybody says capitalism is ending. Our economic system is coming down. We're going to enter another war. All these things have happened in the past. All these stories have come out before. But if you just turn off the noise, follow the strategy, what we've seen happen over the last 100 years is it works. The name of the strategy is DCA, which stands for dollar cost averaging. And the whole idea here is you are going to invest your money periodically into the market, and you can automatically set this up where every week, every 2 weeks, or at least every month. I personally do, and I like every week, but you can find the best strategy for you, where now every so often, you're going to consistently, passively, and automatically invest your money into a fund that gives you broad exposure to the market. Now, I do got to give you a little bit of a disclaimer right now, because investing does have risks. You are never guaranteed to make money when you invest. You might even lose money, so always talk to a professional before you make an investment decision, and never blindly trust a random guy on YouTube. All the funds that I talk about are just for examples. I'm not telling you what to invest in. So talk to a professional if you have specific questions about your own financial statement. Now the question is, where do you actually invest your money? How do you actually get exposure to the market? Because there's no direct way for you to just invest your money in the stock market. You have to invest your money into something, some investment tool that gives you exposure to something called an index of the stock market. So a fund is, you can think of it like a group of stocks. Because if you go and invest in Amazon or Tesla or McDonald's or Coca-Cola, what you're doing is you're investing in one company. And you're hoping that this company is going to succeed. And you can make a lot of money doing this. But again, now you're putting a lot of your investment risks into one company, because if that company were to go down, if Amazon went bankrupt, well, now your investment goes to zero. And this is where understanding, are you willing to put in that risk and time and energy and research to invest in the company? Or do you want to just invest in a fund that gives you exposure to maybe 100 companies? And maybe Amazon is in this fund. So if Amazon were to go bankrupt, well, the fund would just kick out Amazon and put another company in there. So when you invest in a fund, you get much less risk. And yeah, you lose some of the upside, but you also lose some of the downside. And so for the average investor, somebody who doesn't want to pay attention to all the earnings calls, somebody who doesn't want to read all the financial statements, this is a much simpler way for you to invest. The next thing that you have to decide is what index, meaning what category of things that you want to invest in. Like the Dow Jones is an index. The Dow Jones is an index of 30 companies. Then you have the S&P 500. That's an index of the 500 biggest companies on the stock market. Then you have something like the NASDAQ. The NASDAQ is an index of 100 companies, the largest companies that are not financial. And so you can decide what kind of index do you want to invest in. Do you want to invest in the Dow, the NASDAQ? Do you want to invest in the S&P 500? Do you want to invest in the broad stock market and all the companies? Do you want to invest in tech? Do you want to invest in healthcare? So you can start to think about what kind of index that you want to invest in. Once you start thinking of what kind of things you want to invest in, now you can find the right tool to actually invest in this asset class. And there's a couple big ways for you to do this. One is through an ETF, which stands for an exchange traded fund, and the other is an index fund. These both give you exposure to these types of indexes like the Dow Jones, the S&P 500, or the broad stock market, or even specific sectors like healthcare or tech or whatever, but they give you different types of exposure. Like, I like ETFs personally just because ETFs work just like stocks. You can buy and trade an ETF at any time with most brokerages, and you can sell an ETF as many times as you want. And most ETFs don't have any sort of minimum investment requirement. You can just buy whatever amounts of this ETF that you want. You can compare that to an index fund, which gives you exposure to the indexes that I just talked about. But unlike an ETF, most index funds, you can only buy or sell once in a day. And many index funds also have a minimum investment. It might say that you have to invest at least $500 or at least $1,500 in order to get exposure to the index fund. So you have more restrictions with an index fund, but they work very similarly to ETFs. It really doesn't matter which one you use. Some people love index funds. I personally just like ETFs. Here's a few examples of how it works. And again, I'm not telling you what to invest in, just giving you some examples. So the S&P 500 is an index of the biggest 500 companies in the stock market, and a couple popular ETFs that give you exposure to the S&P 500 are SPY or VOO. I personally have some of my own money invested in VOO as a disclaimer. So now, when you invest your money into SPY or VOO, you're getting exposure to the 500 biggest companies in the stock market. They trade just like stocks. These are ETFs, and it's a simple way for you to get exposure to the entire index. For the NASDAQ, which is an index of 100 of the largest non-financial companies, many of these have been tech companies over the last decade, but for the NASDAQ, one of the most popular ETFs that gives you exposure to these companies is QQQ. This is an ETF created by Invesco. Invesco is the institution that manages and creates this investment fund. This is created by Vanguard. This one's created by Spider. All these are different institutions that create these types of investment funds. For the Dow Jones, which is that group of 30 companies, the most popular fund is DIA. And then if you just want total exposure to the stock market, you want broad total stock market exposure, you could look at an ETF like VTI. This one is by Vanguard. Once you know what kind of funds you want to invest in, the next thing is creating a system so your money is automatically invested into these funds. That way it can be consistent, passive, and automatic. And the best way to do that is to find a brokerage that specializes in this type of passive investing. When I say passive investing, I mean where your money is automatically pulled out of your account and invested into your portfolio of funds. And so there's a number of brokerages that do this now. You can look for one yourself. I use a platform called M1 Finance. They are an affiliate of mine. I'm not telling you what to use. Do your own research. But if you want to learn more about them, I put my affiliate link down in the description below so you can see some of the other platforms that I use. But again, there's a ton of them out there. Find the one that's best for you and always do your own due diligence. So what you want to do now is create a system where anytime you get paid, you have money that's automatically pulled out of your account and invested into your portfolio of funds, and then you don't touch it. This is the key. This is the key if you want to succeed with this. You don't touch it when things go wrong. You don't touch it when things are crashing in the markets. When I say things go wrong, I mean like you see the economy slowing down or when you see the markets are going down. Because if you start to see these types of things happen, now the money that you invest will allow you to buy more shares of these funds. If something really goes wrong with Vanguard or with Spider or with Invesco or one of your investment institutions, then that's a different story. But this is where your job is not to be paying attention to the markets every single day. This is where your job is not to be stressing out about earnings calls and to be paying attention to every single company. This is where you've created a passive system. And now your money is being invested. You do this every week, every 2 weeks, every month. It's completely passive, it's consistent, and it's automatic. And you don't touch it, and you're going to let this happen for years. You're going to let this happen for decades, and let your money give you exposure to the markets and let it grow and compound over time. I do a mix of things. I have my passive investing strategy like I just talked about, but I also have an active strategy because I like researching companies. I like taking on some of the extra risk. I enjoy keeping up with the markets. So while I have my passive strategy going on, I also have cash for my active strategy. And you got to find what's right for you. Maybe you'll do a hybrid. Maybe you only do passive. Maybe you only do active. You got to find what's the right strategy for you. But at the end of the day, this is where it pays to be financially educated. That way you don't just blow your money on things that don't matter to you, and you don't get greedy, you don't start panicking, you don't go through all the emotions of stock market investing, because the things that make the stock market so great are the same reasons why investing in the stock market is so difficult, because you can get very emotional. And this can be great when things are going up, but it's 10 times more painful when things are going down, and this is where you want to be financially educated. When I invest my money, there's two things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm gonna expect very different returns to justify my investment. Bunty is a risky investment, so I'm gonna need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's gonna invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's three different ways that you can take this. Option one is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option two is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you got to manage and monitor a whole portfolio of your stocks. Or option three is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF, and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all three of these funds give you exposure to the stock market. They work in very different ways which can affect how much money you make, which is why you want to understand the differences, and that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you were hoping that by paying this money manager a fee, you are going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees, and if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm going to go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard, and Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund, and you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF. ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title. Also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy one share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest, versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money, versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, the index fund gives you the benefit, because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. Do you want to have the automatic reinvestment into an index fund, or do you want to just invest invest your money into a brokerage that can automatically invest your money for you. Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. Most people think that the way you build real wealth in the stock market is by finding the next Amazon stock before it pops off.
Amazing Amazon. The company becomes the second one ever to hit $1 trillion valuation.
This strategy works for some people, but not most people. Actually, when most people try to invest in stocks or pick stocks, they end up losing money, either because they overpay for the stock, or they don't know how to pick a good stock, or they sell their stock for a big loss because they get scared because something's happening in the economy, or they just sit on the sidelines and do nothing. However, everybody has the ability to be a millionaire stock market investor if you know how to do it the right way, and it's not by picking stocks, it's not by trading stocks, and it's not by starting off with millions of dollars. Let me show you. If you can invest $100 a month, and this is something that everybody should be able to do, if you cannot invest an additional $100 a month, then you need to go and watch some of my other videos about how you can live smaller or earn more money. That way you can put aside $100 a month. This is less than $4 a day. But if you invest $100 a month and you can get a 10% average return on your money, which historically has been the return of the stock market over the last century, and you do this for 46 years, you will retire with over $1 million in your investment account. If you put your money in the market and you can get the market return and you do this for long enough time, you will be a millionaire. The problem is most people don't do this. Most people don't get these returns. Most people lose money and then they hate the stock market and they think that investing is only for rich people. And in this video, I'm going to go over how you can actually become a millionaire in the stock market. And it's not by picking the best stocks. But if you really want to see that success in the stock market, you have to follow a system. And this is the 3-step system that I'm going to be talking about. Number 1 is research. Number 2 is fund. Number 3 is automate. Let's start by talking about number 1. How do you actually research the right way? Now, when I talk about doing research, I'm not talking about researching individual stocks. We're talking about researching investment vehicles. And the 3 that I'm going to be talking about are ETFs, mutual funds, and index funds. And all 3 of these work very similarly with some little differences between them. But in general, the way that these funds work is instead of you going out and investing in a company like Amazon, now what you're going to do is you're going to invest in a group of companies. If you invested in the Amazon company, you put all of your money into this Amazon stock and Amazon takes over the world, this would be great news for you as an investor because now your stock price would soar. But if Amazon does something bad and the CEO runs the company into the ground and then they declare bankruptcy, well, now your investment go down to 0. So when you invest your money into the individual company, you're taking on more risk. You can see more upside, but you can also see more downside. And this is where there's a lot of work required to find the right company, to research the right company, and then you have the psychology aspect to actually how do you invest in the company. When's a good time to buy? When's a good time to sell? And this is why the majority of people lose money in the market, because they don't have the time to do the research, they don't know how to do the research, and they don't have the psychology to invest their money in the stock market. That's why for the majority of people, it's a much better idea to invest in these types of funds, because now the way it works is instead of investing directly into the Amazon company, you're going to invest into this fund which owns the Amazon company. And in addition to Amazon, it might own some McDonald's, it might own some Coca-Cola, it might own some Nike, it might own some other stocks in here. And now you have this basket of maybe 100 stocks or 500 stocks or 1,000 stocks. So now, if Amazon takes over the world, well, you're going to see some benefit here in the fund, but it'll be balanced out by some of the losers. However, if Amazon went bankrupt, then the fund would kick Amazon out and put another company in. So now you're not going to be hurt as bad by the Amazon bankruptcy, because now they will replace it with another company and it'll be balanced out by some of the winners. So when you invest your money into these types of funds, you don't have to worry about doing the same type of research if you're trying to find the perfect company, because now this fund, whether it's an ETF, a mutual fund, or an index fund, is working to have the right group of companies there for you. That way now you're investing in a particular index, a particular basket of stocks, and I'll explain what that means in just a second, but you're picking this basket that you want to invest in, and then this basket will readjust based off of what companies should fit there. That way it's not a permanent group of companies. If Amazon goes bankrupt, it'll be kicked out, and maybe Chipotle will come in. So these types of funds lower your risk, meaning they lower your downside, but they also lower some of your upside. However, if you're just trying to meet the returns of the market, these funds can allow you to do that without all the time and without all the risk. Now, how do you find these types of funds? Well, this is where you can look at ETFs, mutual funds, and index funds, because they work similarly with a little bit of differences. So let me start by talking about mutual funds, because these are what are generally known as actively managed funds. That means that the person who's managing the fund is actually a person. They're typically a well-educated money manager who you're going to be paying a fee to manage. Now, the good side here is you have somebody there trying to find you the best stocks to keep in this fund. The downfall is it's going to cost you more money. The fees are going to be higher. Sometimes the fee will be worth it. Most of the time, it will be not. Now, mutual funds work similar to index funds in that they have some restrictions. If you want to invest your money into a mutual fund, most of the time, they're going to have limits to how much money you have to invest. There will typically be a minimum. It might be $100, it could be $5,000, it could be upwards of $5 million, just depending on what the fund is. But there will generally be some minimums in order to invest. Not all of them have minimums, but some of them do. And then many times, mutual funds will also have restrictions on how often you can buy and sell this fund. Unlike a stock, you can buy Amazon and sell it within the same minute. When you buy a mutual fund, you don't have the same ability. Many times, not all the time, but many times, you can only buy the mutual fund or sell it once in a day, and there's only one slot to do that. So you can buy it only once in a day, so you can't trade out of these funds. This is kind of similar to index funds, but the difference between index funds and mutual funds is that index funds are generally passively managed. And what that means is now instead of having a money manager manage it, you are going to have a computer managing the fund. What that means is now you can build an algorithm that I'm going to invest in an index of the biggest 500 companies in the stock market. This is what the S&P 500 is. So now when you enter this algorithm, the computer will automatically make adjustments when it needs to be done. If Amazon goes bankrupt, well, then the computer will kick Amazon out and they'll put in the next biggest company. Now, the advantage of this is your fees are significantly less. Now, sometimes this will be great, other times not, but overall, what we've seen throughout history is for the average person, the higher fees tend not to be worth it. This isn't the rule 100% of the time, but generally higher fees mean it's going to eat up more of your profits. Then index funds many times also do have the same minimums like mutual funds do. This can be as low as $100 up to millions of dollars depending on what the fund is. And then index funds many times also have the same restrictions where you can't trade in and out of an index fund the way you can a stock. ETFs work very similar to index funds, but they can be actively or passively managed. So these are active or passive, but the difference between now ETFs and mutual funds and index funds is they trade just like stocks. So you have no minimums generally unless there is a brokerage that you're working with that doesn't allow you to buy a fractional share. For example, if the share of an ETF is trading for $100 a share and you don't have $100, some brokerages will let you buy a fractional share for $20. So you're buying $20 of a $100 share. But besides the restrictions to buy a fractional share, there's generally no restrictions to buy an ETF. There's no minimums, and you don't have the restrictions because now you can trade in and out of an ETF whenever you want. This is where I want to remind you that if you want to succeed as this type of investor, this is called passive investing. If you want to succeed as a passive investor, the key is you have to be a long-term investor. And by long-term investor, I don't mean 6 months. I don't even mean 6 years. A passive investor is somebody who wants to invest in these passive investments for the next number of decades. When you have that type of long-term horizon, you can win as a passive investor, but you have to be in it for the long term. Personally, I'm a big fan of ETFs because of how easy they are to access, but for other people, that's exactly why they hate ETFs, because they don't want to have to sit there and monitor the stock brokerage accounts versus an index fund or a mutual fund. If you're buying it directly from the investment institution that's issuing it, well, now it's much simpler on your end because now you don't have to stress about what's happening in the stock market and staring at your stock brokerage portfolio each and every day. It kind of happens a little bit more discreetly because you're not seeing the day-to-day price moves the way you are with an ETF. This is where now when you're picking your investment vehicle, and I'm going to go over a bunch of different examples in just a second, you have to remember what your goal is as an investor, because that's going to help guide your investment decisions. And your goal can generally be, I want growth with my money, meaning I want to see the value of an investment go up, or I want cash flow, or a hybrid of these two. Growth means I'm investing my money into something that has more risk, but it has the potential to grow a whole lot more quicker. Because now these are companies that are generally smaller, they're trying to grow quicker, they don't have a lot of profits because they're reinvesting all their money back into their company, versus cash flow is now, this is a company that has big profits. They're making a lot of money, they're already very large, and now with their profits, they can just pay it out to their investors, people like you and me, in the form of dividends. So now you're getting cash flow in your hand. It's a little bit less risky, but you're going to see a little bit less upside because now these companies aren't going to be growing as fast as maybe a growth company. So a little bit less risk, but you're getting more cash flow today versus I want more risk for the potential for higher potential growth. Now, once you know what your goal is, this can then dictate how you're going to be investing your money. For me, the bulk of my stock market portfolio, especially my passive portfolio, is for cash flow, because for me, I like cash flow. Cash flow funds the guac flow, because when I have this type of cash flow, well, now I have investments that are paying me every single quarter, and every 3 months I get more money deposited into my investment account. Now for me right now, this money that gets deposited is being reinvested, buying more cash flow producing assets. So every week I'm putting money into my accounts. That way it can buy me more cash flow. And then when my cash flow investments pay me with cash flow, I'm using this cash flow to buy even more cash flow. So it's like a machine that's constantly working to produce more cash flow for me. Let's go over some examples so you know exactly how this works and what it looks like. Now I gotta remind you that everything that I'm about to discuss are just examples. I'm not telling you what to invest in. You have to do your own research. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. So let's go over some examples of how this works. Let's say you just want to put your money into the stock market. Well, there's an ETF for that. There's a total stock market ETF that gives you exposure to pretty much all the major stocks on the stock market. This is VTI. So if you invested in this VTI ETF, it is by an investment fund called Vanguard. You can look it up on Google. Go to Google and search VTI Vanguard, and you will learn everything about this. And what you'll see is that this gives you exposure to the broad stock market. So when you invest in this, you're getting exposure to the stock market. If you want to invest in the S&P 500, which is a group of the 500 biggest companies on the stock market, well, there's an ETF for that. And I should also tell you that these ETFs with a star next to them are funds that I have my own money invested in, just as a disclaimer. But if you want to invest in the S&P 500, then you have a couple ways to do that. You have SPY and VOO. Both of these are two different ETFs that both give you exposure to the S&P 500. They're created by different investment institutions, but they invest in the same 500 companies generally. The difference is SPY and VOO will have a slight difference in asset allocation. That means that they value some companies more than others, because both of these ETFs create funds of the 500 different companies, and then they allocate their money accordingly based off of what they think is the best. Well, VOO and SPY have some slight differences. Like they value Tesla a little bit differently, they value Johnson & Johnson a little bit differently, but besides that, they work primarily the same way. Now, these are two ETFs. VFIAX is the index fund version to invest in the S&P 500. So now, if you put your money into this index fund, now you're investing into the S&P 500 through an index fund as opposed to an ETF. VOO and VFIAX work very similarly. This is an ETF, this is an index fund. They're both created by the same Vanguard. If you wanted to invest in the NASDAQ, which has a lot of exposure to tech companies, then you can look into the QQQ ETF. If you wanted to invest in the Dow Jones, you have DIA. If you wanted to invest in just value companies, well, Vanguard has an ETF for that. It's called VTV. If you wanted to invest in emerging markets, these are countries and companies overseas that don't rely on the dollar, that are working to grow. This is VWO. So it's a way to diversify your money outside of the United States. And if you want to invest your money into dividend-paying ETFs, this is an ETF that invests in high dividend-paying companies, then you can look at something like SCHD. This is a dividend ETF. Now, let me remind you that this is not a comprehensive list of ETFs. There are so many different ETFs out there. There are even more ETFs than just this for dividend or emerging stocks or everything else. There are so many ETFs out there, which is why this is just a place to start, and then you can start doing more research. But this is where now you can start asking, who is the company that's issuing the ETF? Because if it's a reputable company, well, then that gives you a little bit of assurance. Then you want to look at the number of assets under management, meaning how much money does this fund actually manage? This is very easily accessible information with a quick Google search. And then you want to research what are the actual assets in this fund. Like when we talked about VTI or VOO, you can see that these invest in a particular group of stocks, and each website will show you which companies are listed in this particular ETF. As an investor now, it's important for you not just to stay up to date on what's happening with your investments, but what's happening in the broader economy, because that can influence your investments. And an easy way for you to do that is to join something like Market Briefs. It's a free newsletter that I created to help people like you, to help investors stay up to date on what's happening in the financial markets. It's super easy to read. You can read it in less than 5 minutes every morning. And every day we're breaking down what's happening in things like the general economy, the stock market, the housing market, crypto, the global economy, into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, it's completely free. And I'll put the link to how you can join for free down in the description below. The last bit that I want to talk about when it comes to the research aspect of knowing what you're investing in is looking at the expense ratio and the yield. The expense ratio is the fee that you're going to have to pay for investing your money into a fund. Whether it's an index fund or an ETF or a mutual fund, all of them are going to have a fee, and the fee is called the expense ratio. And this is very easy to find. You can go to Yahoo Finance to find this, Seeking Alpha. You can go to the actual investment institution that's issuing the fund. You just have to look at what the expense ratio is. And what you'll see is that this expense ratio is the fee that you're going to pay every single year for investing your money into this fund. When we talk about part number 2, I'll show you the real cost of this fee, which is why you want to have ideally a lower fee if possible. And then the second thing that you want to understand is the yield. This is the dividend. This is the cash flow that you get. Now, sometimes you're going to be investing in funds for the cash flow. Other funds, you might not be investing for the cash flow, but they might be paying cash flow as well. This yield is the cash flow that you will get. So if it says it's a 1% yield, that means if you invested $100 today, you will get $1 in cash flow just for owning the investment. And this is cash flow that you're getting, not for selling the stock, but just for owning the stock. This brings us to the second step of becoming a millionaire stock market investor, which is now how do you actually fund your investment the right way? Now, in the beginning of this video, I talked about how if you want to become a millionaire stock market investor, you could just invest $100 a month, get a 10% annual return for 46 years, which would reach a $1 million investment portfolio after 46 years. However, what I want you to understand now is that there's 3 aspects which will influence how wealthy you become in the stock market. And these 3 factors are how much money you invest. Here, we talked about $100 a month. Number 2 is the return that you get. Here we talked about the 10% annual return. And number 3 is how much time you invest your money for. Now, the only factor that we cannot change is time, because you cannot go back in time and start investing 10 years ago. So we're not going to talk about that, which is why the best time to start this is today, regardless of where you are in the economy, because, well, the more time, the better. Time in the market beats timing the market. This is what Warren Buffett always says. So now we have 2 factors that we can talk about. One is how much money you invest, and second is the return. When it comes to how much money you invest, this is going to depend on really your lifestyle. It's how much money do you make, and how much money do you spend, and how much margin is there that you can put towards your investments. If you're not happy with how much money you're making, then you can start by making more money. Does this mean getting a second job? Does this mean working harder at the job that you have now? Does this mean you're working for a promotion? Does this mean you're working for a raise or a bonus? Now you're working to earn more money with the purpose of investing more money, because the more you invest, the wealthier that you will become. If it's not from a job, can you create a side hustle? Can you start a business? Is there something else that you can do? Maybe you get a certificate, you look for a new career, you look for a new job, you do something that way you can earn more money, because now you're earning more money with the purpose of having more money to invest. Then on the flip side is also, can I spend less money? Are there places where you can cut back? Can you get rid of your car? Can you live a little bit smaller? Are there things that you don't need that you can sell, that you can get rid of? That way you have more cash now to invest. So you can earn more and you can spend less, which will create a bigger margin, meaning you have extra cash. But the question is, why are you having the extra cash now? Are you just going to keep this cash in the bank, or are you going to put this money to work? If you put this money to work, now you will have more money. So the key here now, if you want to see bigger success, well, you need more money to invest. The more money you invest, the wealthier you will become, period. And we're just talking about how you can do that. You can earn more, you can spend less. I'm not going to go too deep into now how do you earn more, spend less in this video, but I have other videos on my channel where I discuss that. Now let's talk about the return, because this is what can now make or break your investments. And I want to start by talking about fees, because I kind of hinted at that when I was talking about the research, because fees can eat up your return. If we come back to this example here, where you turn your $100 a month investment to $1 million, but this time now you're putting your money into an investment that gives you a 1% fee. So you're getting the same return, but then you have a 1% fee. Well, this 1% fee isn't going to eat up 1% of your investment portfolio. It isn't even going to eat up 10% of your investment portfolio. It isn't even going to eat up 20% of your investment portfolio. If you have a 1% fee, you're not going to end up with $1 million. You're going to end up with right around $750,000, because this small little 1% fee isn't just a 1% fee you pay once. It's a 1% fee you pay on every dollar that you invest, which means you have less money invested. And then every dollar that your dollar grows to each and every year. So now you're compounding your money, but you're also compounding your fees over the entire course of your investment. Now again, this doesn't mean that these fees are never worth it. There are some places where these fees will be worth it, assuming that now you can justify the fee with higher returns. But you're going to need much higher returns to justify even just a 1% fee, because that 1% fee can really eat up the value of your investment portfolio over time. And if now you can't get a 10% return, but you get a 7% annual return, well, now the years are a little bit different. If you're still investing the $100 a month, now it's going to take you 60 years to hit that $1 million. If you're investing the $300 a month, now it's going to take you 44 years to hit that $1 million mark. And if you can invest $1,000 a month, now it'll take you 28 years to hit that $1 million mark. Again, it's very accessible. The more money you invest, the more wealth you will achieve. But this is where understanding that these types of returns are achievable, and you can get better returns the more research you do. But this is where you got to pay attention to the fee and what you're investing in. But you have to be willing to do the research. You have to be willing to fund it. And then you got to do number 3, which is automate it. The way you can actually succeed as this type of passive investor is you want this to be as passive and automatic as possible, meaning every week or every 2 weeks or every month, you pick your own interval, but every so often, money is automatically going to be invested, and this does not change. It doesn't matter if the market's up or down. You do this for a number of years, if not decades. That way you can actually build wealth, because you need the time, but you have to have it be passive, and that means you want it to be automatic because you don't want it to rely on you. For me, every Wednesday, I have cash that leaves my checking account and is automatically invested into my portfolio of ETFs. The reason why I do Wednesday is not any sort of secret sauce or anything. I used to do Monday or Friday, but the problem was that was when the federal holidays would fall, and so there was a number of weeks where I just wouldn't get any money invested because there would be a federal holiday. So I decided to put it in the middle of the week. That way the federal holidays don't really affect my investing schedule, because I want to keep investing as often as possible. For me, I like it every week just because it's more often. So I get a better dollar cost average because of that, but you can pick your own strategy for you. So for me, I have it set up so every Wednesday, cash leaves my checking account and it is automatically invested into my portfolio ETFs. I don't have to check it. I don't have to touch it. I don't have to do anything. It is on autopilot. So now it happens and I don't have to worry about it. For me, it's completely automatic, it's completely passive, and it's a tool that is working to now build me wealth on the side in addition to everything else that I'm doing. I have my active investment portfolio as well, where now I have my stocks in a different brokerage, where now I'm looking for companies to invest in. I'm looking for individual companies that I believe are good valued for me to invest in, but that is my active investments. It's more risky, more time intensive. My passive investments in the stock market are on autopilot, and now when I get my cash flow from my passive investments, it's automatically invested. So it's working to buy me more cash flow. So every week I'm putting more money into it. Some of these investments are paying me with cash flow. When I get this cash flow, it's buying me even more cash flow investments. So it's like a machine working to buy me assets, and these assets are buying me more assets themselves. The key here for you is you don't want to turn this off because people get scared. Oh, the market's going down, so I should sell out of this. Or I should change my strategy because of what's happening outside. Once you pick the ETFs that you want, you're done on your end. Now you set it up and forget it. You don't have to touch it because now the ETF should be working to pick the investments, to pick the assets, and you just have to keep funding it. The only time you would change it is if something's wrong with the investment institution that your ETF is with, or if something is wrong with the ETFs that you invested in. If you feel like you shouldn't have invested in those ETFs and you want to change it because of that, that would be the reasons why you change it. You shouldn't be changing or selling out of ETFs just because we're going through an economic slowdown. Economic slowdowns, recessions, and market crashes happen. They have happened pretty much every decade now. So you should expect them to continue to happen, and those are just opportunities if you change anything to buy more, and that's it. You shouldn't be changing a strategy besides that. So if you want to be a millionaire stock market investor, you don't have to go out and try to find the next Amazon stock. Instead, you can find the right funds to invest in. These are ETFs, mutual funds, or index funds. And of course, when you're doing this, you want to make sure you research the funds, see what they're investing in, and make sure that aligns with their investment goals and your time horizon. Now, you find the right funds that you want to invest in. The next thing you want to do is set up a system where you're funding these ETFs, and you want to also pay attention to the fees, pay attention to the yield, pay attention to the numbers, make sure that it aligns with your goals. Then you have to automate the system. The way that you win and actually become a millionaire stock market investor is by investing for the long term. You set up an automatic system that was completely passive, and it keeps happening no matter what, and you don't change your strategy just based off of what's happening in the economy. Ultimate financial freedom is when you can sit back, relax, and let your dividends from your stocks pay for your lifestyle. Dividends are one of the closest things to true passive income because once you invest in a company that's paying a dividend, you don't got to go and work at that company. Like if you go and invest in the McDonald's stock, you don't got to go and flip burgers, but if McDonald's keeps paying the dividend, they'll keep sending you a check every 3 months because they're working hard to grow their profits. I'm going to be going over a bunch of different dividend paying stocks and ETFs and different dividend strategies that you could potentially use. But the first thing that you have to understand, I know this is the boring part, is why do companies pay dividends? In order for a company to pay a dividend, they first have to be profitable. They have to pay off all their expenses and still have cash in the bank. Now, when they have this cash in the bank, they can do one of a few things. They can save this cash for emergencies. They can invest this cash back into their company. So if you're investing into a guacamole company, they can use this cash to go out and buy an avocado farm, or they can use this cash to pay off their investors. There's 2 different ways that they can pay off their investors. They can use this cash to buy back shares, which pushes stock prices higher, or they can use this cash to pay out dividends. Dividends are literally just cash checks that companies pay out because you own a company and it's your profit distribution. So they take the profits and then they just give it away to the shareholders, people like you who own their stock. If you want to be really strategic about investing in dividends, and I say investing in dividends because you can also trade dividends. The way that you trade dividends is you buy a stock right before it issues its dividend and then you sell it after, but that's a lot riskier. We're not talking about trading here. If you want to be strategic about how you invest in dividends, you have 4 general strategies that you can follow. You can invest in high yielding dividend stocks. You can invest in high dividend growth stocks. These are companies that are growing their dividends. Then you can invest in value companies that pay a dividend. And then you can invest in REITs, real estate investment trusts. I'm going to talk about all 4 of these, but let's start with number 1, talking about high yielding dividend companies. There are so many articles on the internet that give you lists of the highest paying dividend companies. Let me give you a couple examples. You have SCU and ORC. SCU pays a 24% annual dividend yield at the time of me recording this video, and ORC is a 16% yield. This is Sculptor Capital Management, and this is Orchid Island Capital. Now, I picked these 2 randomly out of one of these high dividend paying lists, but let's just talk about what happens if you would invest in these companies and get these type of returns. If your goal right now is to make $2,000 a month from your dividends, or $24,000 a year, and you can get a 24% dividend, meaning a 24% return on the cash that you invest, that means you'd only have to invest $100,000 here to SCU or $150,000 here into ORC to get these types of returns. Now, that's not a lot of money considering that typically you would need to invest at least $500,000 to be able to comfortably make $2,000 a month in passive income. So to get that with just $100,000 or $150,000, that's a pretty good deal. So what's the catch? Dividends only show you a piece of the puzzle. When you invest your money, you should not only look at the dividends, you have to look at the company in general, and a dividend is a piece
piece of what the company does. So if you're only looking at the dividends, you're only looking at a piece of the puzzle. When you invest in a company that has super high dividends like this, that typically also comes with very high volatility. That means you can see the stock go up and down, and in order for you to really see and maintain these types of returns, you want to make sure that the company that you invest in isn't going to suddenly tank tomorrow. And when you have these type of dividends, you're going to see a lot of volatility up and down in the stock. And another thing that you want to remember, which becomes extremely apparent when you invest in a company with super high dividends like this, is when the dividend is paid out, many times the company's stock price will fall by the amount of dividend that is paid out. So if a company is trading for, say, $100 a share and they pay out a $3 dividend, the day that the dividend is paid out, many times you're going to see that company share price fall to $97. This is a lot more apparent when you have these super high dividends, because now when you pay this big dividend, the stock price falls. So if you get this 24% payout, sometimes you might just see the stock price fall by 24% because of the dividend that is paying out. So you need a strong company that can help drive up the stock price in addition to just paying the dividends. Plus, dividends don't tell you what's going on at the company behind the scenes. So let me give you an example. Let's say you find a stock trading for $100 a share and it pays out a $3 annual dividend, which is a 3% annual yield. So you ignore it and you just kind of go past, you do your own thing, and then some time goes by. You forgot that you looked at this company before, but now the company isn't trading for $100 a share, it's trading for $25 a share, but it's still giving that $3 dividend because they haven't changed or updated the dividend policies yet. Now, from a dividend perspective, this is going to look a whole lot more attractive, because now if you invest, you would be getting a 12% return on your money, which is a great dividend. But what you don't see when you just look at this is that the stock price has been cut into a fourth. So maybe there are some underlying issues. Maybe the company is on the verge of going bankrupt. Maybe the company is about to cut their dividend. Maybe the company is about to get rid of the dividend completely. So there's a lot more things that you have to look at besides just the dividend price or the dividend percentage. You need to understand what's going on with the company. If you don't like the idea of putting in all that work to research a company, then the next best thing is, instead of investing in a high yielding company, to invest in a high yielding ETF like VYM. Now, I'm not trying to tell you what to invest in. I'm just giving you examples. VYM is a Vanguard high-yielding dividend ETF. And the goal of this particular ETF is to invest in a whole bunch of different dividend-paying companies. That way it can pay you a sustainable, higher dividend yield. The advantage of investing your money in an ETF now is you don't have to try to find the perfect company, because if one of the companies goes bankrupt in the ETF will just kick it out and you'll have some other winners that'll balance it out. But that also is the downfall with investing in ETFs, is you're not going to get the highest returns. Your returns are going to be averaged or normalized, because you're going to have some winners and you're going to have some losers. So you're giving up some of the potential returns so you don't have to take on all the risks. At the time of recording, VYM is paying out a dividend yield of 2.8%, which is significantly less than the high dividend yielding companies that I talked about just a minute ago, which means that if you're trying to get $2,000 a month from your dividends, you would have to invest right around $850,000. Now, it's a lot more than we were just talking about, but your money is going to be a lot safer here than investing your money into an individual company. The second way that you can invest your money to get that dividend passive income is by looking for growth. Now, typically when we talk about growth, especially when we talk about stocks, we're talking about investing your money in a stock that's trading for $100 a share today to hopefully go up to $200 a share sometime in the near future. But when we talk about dividend growth, it's a little bit different. When we talk about dividend growth investing, now we're talking about investing in a company that's paying out a dividend that's growing year after year after year. And you have a few different types of dividend growth companies. You have dividend challengers, sometimes they're referred to as dividend achievers. You have dividend champions, sometimes they're referred to as dividend aristocrats. And then you have dividend kings. All this means is a dividend challenger is a company that has consistently been paying and increasing their dividends over the last 10 years. A dividend champion is a company that has consistently been paying and increasing their dividends over the last 25 years. And a dividend king is a company that has been paying and increasing their dividends over the last 50 years consistently. A few examples of dividend challengers are JP Morgan Chase Bank, Apple, and Pfizer. Both JP Morgan Chase Bank and Pfizer pay around a 3% annual dividend at the time of recording, and Apple's paying around a 0.5% annual dividend. So again, this means that these companies have been paying dividends and increasing them steadily over the last 10 or so years. And if you want to get that same $2,000 a year in cash flow and you're getting about a 3% annual return, that means you'd have to invest $800,000 to get the $2,000 a month in dividend cash flow. With Apple, who's only paying a 0.5% annual dividend, you'd have to invest significantly more. You'd have to invest $4.8 million, but that's because their dividend is only 0.5% a year compared to the threes. A couple examples of dividend champions are IBM and J&J. IBM at the time of this recording pays around a 5% annual dividend, and J&J or Johnson & Johnson pays around a 2.5% annual dividend, which is around the JP Morgan and Pfizer dividend yield. Now, with the 5% annual dividend, you'd only have to invest $480,000 to get the same $2,000 in cash flow a month. And then we have the select few, the dividend kings. These are the companies that have been paying and growing their dividends steadily for the last 50 years or more, and a couple examples of that are Target and Coca-Cola. At the time of this recording, Coca-Cola is paying just under a 3% annual yield, and Target is paying right around a 1.5% annual yield. If we do the math, at a 1.5% yield, you'd have to invest $1.6 million to get that $2,000 a month, and at the 3% annual yield, again, you have to invest about $800,000 to get that same yield. Now, I want to clarify one thing. This is not investment advice. I'm not telling you to invest in these companies. These are just examples that I'm giving you, going over the different types of dividend strategies, but you need to make sure you always do your own due diligence and do your own research, because investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you gotta always do your own due diligence and never blindly listen to a random guy on YouTube. The third way to generate this type of dividend cash flow is by investing your money for value. So up until now, we've been talking about investing your money solely for the dividends. But another way that you can invest your money is investing your money into value-based companies. A value-based company is a company that is profitable, that has good fundamentals, that's creating a good product, and that's innovating for the future. Now, you're investing in this company because you like the company, you believe in the company, but one of the benefits of investing in this company is you get paid a dividend as well. So you don't get necessarily the biggest dividends with these value companies, but you're investing in a strong underlying fundamental company. The reason why I'm talking about value companies instead of growth companies, not growth dividends, but actual growth companies, these are your smaller startup techie type companies. These smaller startup techie type companies usually are not profitable. They're spending every dollar that they can, and sometimes more, through the help of debt or investment dollars. That way they can grow bigger and faster to grab market share. So if they don't have a profit, they can't pay out a dividend. As opposed to these value companies, these are typically your larger companies that have already established that market share. These are your brand names that everybody knows. A lot of them are the dividend paying companies that we just talked about, like Starbucks, McDonald's, Pfizer, Coca-Cola. These are all dividend paying companies that are also value companies. But what you're investing for here is not necessarily the particular dividend, but the underlying value of the company. So if you don't want to do all the research or doing the fundamental analysis of a company, the next best thing is to invest in an ETF that gives you exposure to these type of companies, and that would be something like VOO or SPY. Both of these are S&P 500 ETFs. I have some of my own money personally invested into VOO. They both give you exposure to the biggest 500 companies on the stock market. That's what the S&P 500 is. So when you invest in VOO or SPY, you're investing because you want to get exposure to the biggest 500 companies on the stock market. But one of the benefits that you get kind of as a side benefit is you also get a dividend. At the time of recording this video, you get approximately a 1.3% annual dividend for investing into these S&P 500 ETFs. That means if you wanted to go out and invest in these ETFs today and start generating $2,000 a month in passive income tomorrow, you'd have to invest something like $1.8 million in order to do that. But the other benefit that you get here is that over the last 10 years, we've seen VOO particularly, it's about the exact same for SPY, we've seen VOO grow by more than 14% a year on average over the last 10 years. Which means if 10 years ago you invested $10,000 into this, not only would you be getting a little dividend, but you're also seeing a 14% annual growth on your money. So you would have 4 times your principal over the last 10 years. So if you invested $10,000 10 years ago, that would be $40,000 today, and you'd also get some dividends along the way. And the fourth way that you can invest for this type of dividend income is by investing your money in REITs, which are real estate investment trusts. These are types of stocks in the stock market, and the reason why I give REITs their own category is because REITs follow some unique rules. So the way that these companies work is these are companies that go out, they build and they buy real estate, and they make money through rent. So tenants live in these apartment complexes, they pay rent to the company, and then this company makes a profit. Well, these companies are required to follow the 90% rule, which says that they're required to distribute 90% of their taxable income, meaning their profit, over to shareholders through dividends. So these companies are required to pay out most of the profits in dividends, which is why many times you're going to see REITs pay out higher dividends. So if you're looking for a way to invest in real estate, I personally am not a huge fan of REITs. I like investing in actual real estate. But for the people that love investing in stocks, they like REITs because it gives them exposure to real estate, without having to actually invest in real estate. It's not for me, but let's talk about REITs for a second. A couple examples of this, again, I'm not telling you what to invest in, just a couple examples, is SPG, Simon Property Group. This is a very popular REIT. This is a company that invests in real estate, and at the time we're recording this video, they're paying around a 5% annual dividend. Now, the alternative to invest in individual companies would be to invest in an ETF. Again, this is another Vanguard ETF. VNQ is the Vanguard Real Estate ETF. This is an ETF that invests in a bunch of different REITs, and at the time of recording, VNQ is paying around a 2.2% annual dividend yield. So a couple ways that you can get dividends from the REIT sector are one, through investing in individual companies, or by investing in ETFs that give you exposure to REITs. The last thing that I want to mention about this, which is arguably the most important thing, is no matter what strategy you pick, if you want to succeed with a dividend strategy, the key is not to just invest all of your money today. The key is to be a consistent investor. That means you create a system where every week, every 2 weeks, every month, you find whatever it is that you want to invest in, stocks, ETFs, and you're just going to keep investing your money into these stocks and ETFs. That way you can build up your portfolio over time, because most of us don't have a couple $1,000,000 just laying around in a bank account to just go out and make a big purchase. So what you want to do is you want to create a system where every time you get paid, some of your money is automatically buying whatever it is that you want to buy. Then, if you really want to grow your dividends even faster, you want to create a DRIP, dividend reinvestment plan, where now as soon as you get paid the dividends, this money goes back into the company to buy you more shares of the company. That way you can get even more dividends. So if you don't need the cash flow right now, using this dividend reinvestment plan allows you to keep buying up more shares of the company, which gives you a bigger piece of ownership, which ultimately pays you with bigger dividends. Now, if you're investing in a strong company where the value is going up and they're paying higher dividends, the value that you're getting just keeps compounding and compounding, because now you're investing your money today, you're buying shares of a company that's going up, and you're buying dividends that keep increasing, and the dividends that you're getting are being reinvested to keep buying more shares of this company, which will ultimately pay you with more dividends. So this is why it's so important to not just blindly throw your money into a company that pays out a dividend. You need to do the fundamental research. That way you can invest your money into a company that will continually keep growing and innovating and produce bigger profits for you, because that's how you're going to get the biggest bang for your buck, instead of just trying to get the high dividend today because you see a big dividend yield that you want to capitalize on right now.
Do you want to know how wealthy people organize their finances? Here's a hint. They don't just keep all their cash in one bank account. I'll show you. What wealthy people do is they have designated money for spending, they have designated money to be invested, and they have designated money to be saved for an emergency. They know what every dollar they earn is going to do. They build a system. I'm working to earn this amount of money, and then out of this amount of money, some of it is going to be spent, some of it is going to be invested, some of it is going to be saved. And the reason why is because they have built a financial plan. They've already built the financial models to know, if I invest $1,000 a month or $500 a month or whatever the amount of money is, I'm going to be able to hit my financial goals. But in order to get there, you have to start by at least organizing your money. And the simplest thing you can do to do this is you got to just figure out where your money is going. And this one is a little bit difficult, but it is so necessary for every single person. You have to track your money. In business, we say if you cannot track it, you cannot optimize it. It's the exact same with your personal finances. So what I want you to do is take a piece of paper, take a Google sheet, I don't care, and you want to write down on the top how much money you're making. How much money did you make last month? I don't care if it's from your business, from your investments, your job. Write down where your money came from, and write down how much money you made from your income, from your job, from your business, from your investments. Write that down at the top. Then below that, you want to write down your expenses. And you want to spend a little bit of time doing this. This is going to take time. Take out your credit card statements, take out your debit card statements, take out your bank account statements, and see where all of your money went, and then categorize them by groceries, by your housing costs, by your vehicle costs. Categorize them and write down every single expense. You need to know where every penny went. And then below that, write the other places where your money went. Did you invest any money? If so, how much and where? Did you save any money? If so, how much and where? Did you give any money to charity? If so, how much and where? Now when you do this, you're going to see a clear picture of how much money you're earning, how much money you're spending, how much money you're saving, how much money you're investing. Now, if you're not saving or investing any money, well, that's already a big red flag right there. And if your expenses are higher than your income, that's another huge red flag. And so now what you're going to see is Where is your money going? And immediately, I don't have to tell you what to do here. You're going to immediately be able to make adjustments in your finances because your money is going to be staring right back at you and saying, whoa, whoa, whoa. You're spending too much money at restaurants. You're spending too much money on airline tickets. You're spending too much money on travel. And if you're not tracking your money, you are never going to have a chance to become wealthy because you can't even see where your money is going. So that's the first step, is you got to track where your money is going. The second thing you want to do now is you have to open up at least 3 different bank accounts. And most banks are going to let you do this for free. If your bank is charging you, go out and find a new bank. You don't want to pay for your banking services. But you want to open 3 different bank accounts. And when you earn money, if you're getting paid a salary from your job or if your business is paying you a salary, this money needs to go into one checkings account. And then out of that checkings account, you want money to automatically be pulled out and put into your other 2 bank accounts. Because your bank account number 1 is your spending money. Bank account number 2 is going to be your investing money. And bank account number 3 needs to be your savings money. Now, the amount of money that you save is going to depend on where you are financially. I generally say somewhere between 3 to 12 months worth of expenses. You got to find the right number for you. I'm not a financial advisor. Everything that I say is for educational purposes only, so make sure you understand that. But generally, 3 to 12 months worth of expenses is going to be enough for people regardless of where you are in your life. So if you're 23 years old, you're just out of college, you don't got any financial liabilities, you don't got a lot of responsibilities, maybe you only need a few months worth of expenses saved up. If you're 45, you got kids, you got responsibilities, you got liabilities, maybe you need 6, 9, or 12 months worth of expenses depending on your risk tolerance. So you got to work to build up the savings depending on where you are financially. Your second bank account, which is your investing money, this is where your wealth is built. And the thing that you want to understand about this is there are ways for you to automatically actually invest your money. And then there are places where you just want to keep this cash waiting for a good investment opportunity. And this is going to depend on you because I personally like both. I have a system where money is automatically invested. Every Wednesday, I have cash that's leaving my checkings account that gets invested into the stock market. I'm investing into different asset classes like even physical gold every month. But let's talk about the stock market. Every Wednesday, cash is pulled out of my checkings account and is automatically invested into the stock market, whether the market's up or down, it does not matter. But I also am putting money into my investment account, my bank account, that's cash waiting to be invested, where I'm looking for a good investment opportunity. Now, this could be stocks, this could be real estate, this could be buying a business, this could be really anything. I'm just looking for a good investment opportunity because I am an investor. I like investing. This is something that I personally like doing. And I want to spend the time in that, and I also understand the risks. And so now you got to understand what type of investor are you. But the key is you have to separate the spending and the investing and the saving. And the reason why is because when you have all of your money in one bank account, it's very easy to just spend that money because most of us have this net zero mindset because we assume if I got $1,000 in my bank, I can spend $1,000. But to prevent that from happening is you want this money automatically put into your investing cash account and your savings account because now when you don't see that money in your spending account, you're not going to be able to spend it because there's no money there for you to spend. And this is going to make it a lot easier now for you to figure out what can you actually afford. Because when you are working to just spend money and then you invest whatever's left, you are never going to have a chance to become wealthy because you're prioritizing making everybody else rich. When you're working to spend money, when you're working to buy a nice car, when you're working to buy a big home, when you're working to buy the nice clothes, you're working to make everybody else rich. But when you're working to buy more investments, when you're working to buy more assets, now you are working to make yourself rich. But this requires you now to change the way that you organize your finances. And that's why at the very least, go out and create 3 different bank accounts. Now, a simple rule of thumb that you can follow is 75, 15, 10, which says for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. And now many banks will allow you to build an automatic withdrawal and deposit into these bank accounts. So if you know that you're going to make $1,000 every 2 weeks, you can take $150 and put it into your investment account and put $100 into your savings account every 2 weeks. And you can automate this through your bank. That way now you don't accidentally spend your investment money on a brand new TV.
That's the first thing. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. The next thing you want to do if you want to really organize your finances is you got to organize your investments. And that means now you got to figure out what is your investing strategy. Like what I was talking about just a couple minutes ago, when it comes to investing your money, you can be more of a passive investor, or you can be more of an active investor, or it could be a hybrid of both. I am a hybrid of both. I invest my money in 5 places. I invest my money into my own business, Briefs Media, along with other companies. I invest my money into physical real estate. I invest my money into the stock market. I invest my money into cryptocurrency. And I invest my money into physical gold. Now, I don't recommend what I do to anybody else, but this is my strategy. Some of these are passive. Some of these are active. Like my real estate investments are active. I have to go out and find rental properties. I have to go out and find good investment deals. And then I go out and I invest in it when I feel like it's a good price in a good area in a growing neighborhood. That's what I'm looking for. When it's the stock market, I have a passive strategy, but I also have an active strategy in the stock market as well. If I see a great investment opportunity in the stock market, maybe it's a great company that has just been hit hard by the economy or by something else going on in the market. Well, now I can go out and buy this company that I believe is a good investment and buy it. But beyond that, I have my passive strategy, which is every Wednesday, I have cash leaving my account and it's automatically being invested. And this is whether the market's up or whether the market's down. It does not matter. I'm always, no matter what, contributing to my investing. Now, the key here is you have to figure out what are you prioritizing. Are you going to prioritize your investing, or are you going to prioritize your spending? Because most Americans, and I'm not saying this generally, I'm saying this statistically, most Americans prioritize their spending. Meaning, when something comes up in life, let's just say your friends want to go on a vacation, or somebody's having a baby, or somebody's having a wedding. What are you going to do? Are you going to prioritize paying for that gift or paying for that event? Or are you going to prioritize investing that money first? And if you really want to become wealthy, you have to prioritize building your wealth first. Which means sometimes you got to make some sacrifices. And you got to figure out which sacrifices you're willing to make. Maybe you got to downsize your car. Maybe you got to downsize your home. Maybe you got to downsize how many times you're going to eat out a week. Maybe you're going to downsize your clothes. You got to downsize something in order to make the ability to keep investing your money. And as you're doing that, the next thing you want to do is work to earn more money. Now, the reason why you want to work to earn more money isn't so you can drive a faster car. It's so you can own more assets, which will buy you that faster car. That is the key, because what wealthy people are doing is wealthy people are living off of their investments. They're not living off of the money they're working to earn. When you work hard to earn money and then you spend that hard-earned money, you are working hard to make everybody else rich. But when you work to earn money and then you take this hard-earned money and then you buy assets, you are working hard to make yourself rich. Now, these assets are going to be working to earn you more money, because if you own cash flow producing assets like dividend paying stocks or rental properties, now these assets are working hard to pay you. And if you can live off of this cash flow that your assets produce, now you are financially wealthy. Now the tough part is, this is hard. This is difficult. This is going to require you to make some sacrifices, because if you want to live off of your assets, it's going to take a lot of work. And this is why I call it a decade of sacrifice. It's going to take you a lot of time to see any real significant income from your cash flow producing assets. But if you keep putting money into these cash flow producing assets week after week, month after month, year after year, and you do this for a decade, after 10 years, I guarantee you're going to be able to have some significant income from your cash flow producing assets. But it's going to take you a decade. But if you can do that, now you have a whole new stream of income which can fund a big chunk of your lifestyle. But it requires you to start making that sacrifice today. Because what wealthy people are doing is, number one, they have organized their finances so every dollar that they earn has a job. Some of this money is going to be spent. Some of this money is going to be invested. Some of this money is going to be saved. The more money you put towards your investments, the wealthier you will become. Now,
As you're investing your money, the second question is, how do you invest this money? Do you want to be more of an active investor or more of a passive investor? Then it's now, as you're investing your money, how can you use the income from your investments? Because true financial freedom comes from when your assets can pay for your lifestyle, but that's going to require you to put in that work now, to own the assets, to make the sacrifices, build the cash flow, and then start to live off the cash flow. And this is sacrifice after sacrifice, but if you can do this, now you're going to build that true financial wealth, that true financial freedom that most people only dream of.
If you want to get your finances in order, the first thing you need to do is not hire an expensive money coach or financial planner or financial advisor. The first thing you need to do is just track your money. Once you track your money, you want to make some adjustments to how you're spending your money. Once you make those adjustments, make sure you're implementing those adjustments, and then rinse and repeat. As you